To the Tuesday, July 31st, 2012 meeting of the Finance Committee of the City of Santa Barbara. And seeing no members of the public whatsoever, I'm not going to open public comment at all. So we have investment reports.
Yes. Good afternoon, Chair Francisco and committee members. I'm Jill Tara, Treasury Manager, and I'm here with the second quarter investment report ended June 30th, 2012, which marks the end of our fiscal year 2012. So we'll take a look back at some of the measures over the last year, but we'll start with our traditional report that we come to you with every 30 days. We'll start with economic highlights. Just one moment. Emergency in the office. We'll start with economic highlights as we do each quarter. We had a disappointing second quarter. Investors sold off much of their a lot of their holdings in May. There was a slight rebound in June, but this volatility caused us to lose much of the value and the gains that had occurred in the first quarter when investors and certainly consumers were more optimistic. We saw a slowing of the economic data released during the quarter, as well as lower earnings reports, lower than anticipated corporate earning reports, which led to the investor sell-off. We're still up for the year. The Dow Jones, the Standard & Poor's, or the S&P 500, and the NASDAQ are still up for the year, but certainly lost much of those first quarter gains. In addition to that slowing of the economic data, we had renewed fears over the global contagion of the European debt and now banking crisis, particularly with the LIBOR scandal that came out where many of the London banks, or some of the London banks, were fixing the LIBOR rate artificially low to lower their perceived operating costs and give the public a better sense of their financial health than was really true. And so I think these renewed fears in Europe certainly led to the sell-off. At the June meeting, the Federal Open Market Committee of the Federal Reserve Bank indicated that they acknowledged the slow economic data, and also they mentioned the global strains, the potential for a global strain in affecting our own economy here. Consumer sentiment was lower. CPI certainly lower than the 2% that the Fed targets at, and stubborn unemployment remaining at 8.2%, which equates to about 12.7 million people out of work, and those are just the labor force that's looking for work, and there's certainly many more people without jobs in this country. The Federal Open Market Committee held the Fed funds rate flat and pledged its accommodative monetary policy to prop up and encourage growth in the economy by expanding long-term holdings through the end of December. So it's going to continue what they call Operation Twist, and this has had a flattening effect, and we'll take a look at that now on the Treasury yield curves. Now, when looking at the Treasury yield, the blue line at the top are the Treasury yields last June 30th, 2011, and this is where we are today at June 30th, 2012. And you can see that the curve has flattened, meaning that even if we go out longer with our investments, we're earning much less. At the short end of the curve, in the 3 and the 6 month, I don't know that they could go much lower, but I've been wrong every quarter. On that. The 1 year stayed roughly the same, but you can see at the 5-year Treasury a year ago, that was at 1.76%, and June 30th it was only 0.72%. And the impact of that is that when the yields on the Treasuries decline, that affects what we can buy into our own portfolio. And when those yields decline, it erodes away our interest income. And we take our interest income and we preserve the principal. We never spend the principal or risk the principal, but we take that interest that we earn and we program it for operations. And so that has an effect on budgets citywide, eroding away the power of our operating income to provide services to the public. So It's not a good trend, but even the Federal Open Market Committee lowered their near-term growth and inflation forecasts, so we don't expect this to turn around, at this point till probably the end of 15. So we're stuck in this low interest rate environment for quite a while. We'll turn to the portfolio activity. Now, during the quarter, we had $25.7 million in agency securities called or matured. Those include Federal Farm Credit Bank holdings, FHLB, the Federal Home Loan Bank holdings, as well as Fannie Mae and Freddie Mac securities. We purchased $14.7 million back in agent securities into the portfolio, and we had the semi-annual year-end interest payment on the airport promissory note for just over $88,000. The remaining balance on that the long-term airport note is about $5.7 million of the original $7.3 that was authorized by council. And that's earning 7%. So that's certainly helping our overall portfolio yield. Turning to the interest and yield on the overall portfolio, the interest earned in the June quarter for the 3 months ended June 30th was just under $623,000. And the interest for the entire fiscal year on the portfolio, of course, that amount is allocated across the city funds, but totaled $2.7 million, and it just continued its steady decline that we've seen over years. We'll look at that in a little bit more detail in a moment. The overall portfolio yield at the end of the quarter was 1.421%, significantly above LAIF and the other benchmarks that we measure ourselves against. And even better than PERS, as Mr. Samario just mentioned, which earned 1% for the same period. Since we are at year-end, and they're certainly not the end of the calendar year 12, but at the end of our fiscal year, I thought it's useful to take a look back and look at our interest earnings. And I spoke about, eroding our ability to use operating income to supplement our services provided. You can see at the end of fiscal year 12, the yellow number on the far left, we totaled $2.7 million overall in the portfolio. That's down $526,000 and a 16.3% decline in the interest income. Although the general funds portion was above the budget estimate, so this is not a budgetary analysis, but it's just a dollar for dollar look at that. You can just see that if you look at the yellow cells, that steady march down. The general funds portion of that $2.7 million in fiscal year 12 was $609,000, so a good chunk of that. And just for my own curiosity, I looked back to see, what was it once? I heard tell that interest income used to be something. Certainly predates me, and don't draw any conclusions from that. Where it's subject to market forces here. But the high, the high was in fiscal year 2001. Our portfolio income in fiscal year 2001 was $8.8 million, and the general fund share of that was $2.8 million, and that's a lot of jobs and a lot of services that we've had to reorient and just redo rework the way we do businesses and provide services, not just through declining in this income or this particular revenue source, which used to be a relatively big piece of the general fund, which now it's really quite small. Back in 2001, the portfolio yield was 6.21%. LAIF was right up there at 6.18, and you can see in fiscal year 12 it was 1.65%. So interesting to look at. We talk, and this report tends to be technical at times, but when you look at it this way, this is what it all means when we talk about yields going up and down and bad economic news. We'll turn now to our typical benchmarks, and this is a look at the end of each of the June quarters over the last 4 years. You can see the portfolio yield at 1.42%. At the end of June 2012, down more than half of what it was even in June of 2009 before the full force of the economy hit our portfolio. At that time, we were still holding some pieces in our portfolio that were earning a significantly higher yield. Those have matured or been called out of the portfolio, and we've just bought in, as we always do, at the current market rate. You can see we're still significantly above the 2-year Treasury note, LAIF at 0.36, and of course the 90-day T-bill, which is a LAIF alternative at basically flat, 0.09%. Lastly, we'll take a look at our portfolio holdings, the change between last month, or the end of May and the end of June. And the net activity between the 2 months was a decline in the book value of the portfolio, just under $5.9 million. You can see that in yellow at the bottom. That indicates that some of the portfolio and cash held in the city funds were used for operations. And we typically see that during this time of year from June through the end of December. We see cash outflows in the city greater than our cash inflows because of the timing of how revenues come in, and that's why we hold, balances at LAIF, which is the state money market account, and we can draw that down for any time. And then by the second half of the year, the revenues start to normalize and come in, and we'll see cash inflows in the second half of the year higher than the first half of the year. So at the end of June, we had $54 million in LAIF. $9 million of that is in the redevelopment agencies, the RDA successor agency account up at LAIF. And I will note that we've been holding the LAIF balance a little bit higher, well, a lot higher than we typically would. At this period, I would really like to see LAIF about $30 million. But at this point, we don't know exactly how much we're going to have to send back as a result of the elimination of RDAs. And so in the interest of not being caught short with a demand for money to send back, we're holding, the portfolio a lot more liquid, if you will, than we typically would. The end of the quarter, we had one certificate of deposit held at Montecito Bank and Trust for $2 million. The agency holdings, the federal agency holdings, the Fannie Mae's, the Freddie Mac's, the FHLB's, and the Federal Farm Credit Bureau bonds totaled just under $96 million. We had about $10 million in corporate notes. We have 4 issues remaining. And the airport promissory note, as I mentioned, outstanding at the end of the month was $5.8 million. That's our base portfolio of $167.5 million. Then we had cash corresponding to outstanding checks that were written on the account at the end of the month, as well as money held for a compensating balance of $4.3 million for a total of $171.9 million. And that concludes my report. I'm happy to answer any questions.
Questions from the committee? Ms. Murillo.
Thank you for your report, Ms. Tara. I was comparing the report you gave us in January, and I noticed that one of the our corporate investments was gone Harvard something.
Yes.
Did that mature, or what was the reason?
That was called.
Okay.
The Harvard, it had a make-whole provision and a call that happened. It was a callable corporate note, and had a make-whole provision, so we actually earned a gain on that note. Typically, they're redeemed at face value, and that one, in fact, if interest rates declined significantly, then they held us whole for that investment. They called it and reissued it at a lower rate.
Okay, and there seemed to be a lot of unrealized losses in January compared to now, but overall it's more of unrealized gains, right? Just
correct.
Certain.
As market yields go up, it makes the value or the market gains on our portfolio go down into losses because the market rates are higher than the securities that we hold in our portfolio. Conversely, when we saw everything drop this quarter, it made everything in our portfolio be held at a gain, a market gain. However, we record everything on the books at book value, and because we do hold everything to maturity, we're required to report on that. But in actuality, it doesn't mean much to us other than we're required to report on it because we earn the interest. We buy a particular piece into our portfolio to earn the interest on it over the term, and then at the end, we get the principal back with no gain or loss.
Okay, thank you.
Mr. White?
Obviously, we're hearing about all the bad news of not getting any interest income from our investment. Conversely, what would the city be able to, what would the city be charged if it were to borrow money on a certificate of participation? Do you have any sense of what that, what comparable cities are having to pay to do a certificate of participation at this point?
I don't. Mr. Samario indicated it's in the threes right now. And we don't really have a cash shortage where we would need to issue revenue anticipation bonds or anything.
No, it's
like
just more
that.
of a, on a capital project
Yeah.
kind of thing, of the
the
police
other side of
headquarters
it,
or
we're
something
not
like that,
earning-
where you might be looking at it. Now, obviously, that's a big discussion that goes on, just asking that out of
Yeah,
curiosity.
interest rates are definitely at historic lows in terms of financing, so for capital projects, whether you issue revenue bonds or COPs. I was just talking to our financial advisor on another issue, and they're thinking close to 3%, which is close to what we're getting, for example, from the state revolving loan fund for some of these water projects, about 3%, so really, really low.
And just to add on to that, that's the purpose of the Federal Open Market Committee holding the interest rates so low, is that it does encourage borrowing and investment and people to spend what they have rather than tie it up long term. So, thank you.
Any other questions? Anything further?
No, just ask for your recommendation to forward this to council. It is on the consent calendar today.
I would so move.
Second?
Any discussion? All those in favor?
Aye.
Aye. So ordered.
Thank you.
Thank you.
Thank you.
Meeting adjourned.